Hello and welcome. When a successful company like California Coasters wants to expand, for instance, by adding a new ride or a fleet of delivery trucks, it needs funding. This funding, or capital, can come from two places. The first is internal financing, which uses the company's own profits, but often that's not enough for big projects. So, companies turn to external financing. Looking at our basic accounting equation, assets equals liabilities plus stockholders' equity, we can see the two sources of external financing on the right side. First, there's debt financing. This means borrowing money from creditors, like banks. This creates a liability, an obligation to pay the money back, usually with interest. A car loan or a bank note are classic examples. Second, there's equity financing. This involves getting funds from owners by issuing stock. This increases stockholders' equity and represents an ownership claim on the business. The specific mix of debt and equity a company uses to fund its assets is called its capital structure. Some companies rely more heavily on debt, while others prefer equity. Today, we're going to focus on two very common methods of debt financing that a company might use to acquire a new asset. Let's imagine our company needs a new delivery truck. We'll explore two ways to finance it, taking out a loan to buy the truck and leasing it. On the surface, they might seem similar. You get a truck and you make monthly payments, but behind the scenes, the accounting is quite different. Let's start with scenario 1, borrowing money to buy the truck with an installment note. California Coasters gets a $25,000 loan to purchase the truck. The loan has a 6% annual interest rate and will be paid back over 48 months. The moment the company receives the cash, the journal entry is straightforward. We debit cash for $25,000, increasing our assets, and we credit a liability called notes payable for $25,000, showing our new obligation to the bank. Now, what about the monthly payments? Our payment is $587.13 each month. But, and this is the key point, that payment isn't just paying back the loan. It's made of two parts, interest expense and a reduction of the principal. This is shown in an amortization schedule. For the very first payment, we calculate the interest on the outstanding loan balance. That's $25,000 times the 6% annual rate, divided by 12 months, which gives us $125 in interest expense. The rest of the payment, $462.13, goes to reducing the actual loan balance. This is why, over time, the amount of interest you pay each month goes down and the amount of principal you pay goes up. So, the journal entry for that first payment would be a debit to interest expense for $125, a debit to notes payable to reduce the liability by $462.13, and a credit to cash for the full payment of $587.13. Okay, so that's buying. But what if California Coasters decides to lease the truck instead? A lease is a contract that gives us the right to use an asset for a period of time without actually taking ownership. Think of it like a long-term rental. Under modern accounting rules, this right to use is actually considered an asset. We also have a liability, which is our obligation to make the lease payments. In our example, the company will make 48 monthly payments. The total cash paid will be over $16,000. However, we don't record the liability at that amount. Instead, we have to calculate the present value of those future payments. Think of present value as what that stream of future payments is worth in today's dollars. Using a 6% interest rate, the present value is calculated to be $15,000. So, at the beginning of the lease, we make this journal entry. We debit a new asset account called lease asset for $15,000, and we credit a liability called lease payable for $15,000. Notice the similarity. In both the loan and the lease scenarios, the company's balance sheet now shows a new asset and a new liability. The core principle is that the company now controls a resource, the truck, and has an obligation to pay for it.